Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. 14th of November is Children's Day. So first of all, let me start off by wishing all the children, just in case they happen to be watching this show, and of course all of their parents out there, a very, very happy Children's Day. Now this is as good a time as any to think about how you parents can best secure your child's future. What is the best way to save up for him or her, whether it's college education, whether it's wedding or any other expenses? What are the right insurance products to make sure that your kids are well taken care of just in case something were to happen to you? These are the questions that we will answer on today's show. Joining me to do that are Abhijit Bhave, CEO of Karvi Wealth, personal finance expert Harsh Rungta, and Sweta Agarwal of Ideal Insurance Brokers. Thank you all very much for joining in. This is a subject that's close to really all our hearts and specifically all the parents out there. And it can be a little more confusing than what meets the eye, I'd like to say. You know, you have these products called child plans. You have products that the mutual fund is offering, that the insurance world is offering. And as a parent, you're always wondering, am I doing the right thing? Am I doing enough to secure my child? So let's get some opening thoughts to begin with. Mr. Bhave, why don't you kick things off?
So, when I was a child, I asked my parents, how much do you love me? And they said, you'll only come to know when you become a parent. So, for anybody, child's future is the biggest dream possible in life. And to convert that into financial goal and to create a perfect financial plan becomes a very important thing for every parent. So, and compared to the yesteryears, it's become very complicated now in terms of how much to save. Because no longer people want to make their children doctors and engineers. There's a lot of education that they can have in India and overseas. There are other costs like tuition fees and students' housing. So they have to create the right corpus. So the options can be many. Earlier people used to put money in property and in gold. Now they put money in financial assets. So you can start by saying that pure debt is a strict no-no because the returns are very low. You look at equity. When you look at equity, you start by saying, let me start looking at mutual funds and let me start doing a simple systematic investment plan. And the point is, once you have the amount in view, once you know the number of years, and once you know how much you have to save, then you look at that. Then you add an element of protection, because if something happens, khuda na khasta, to the parent, then what do you do with the life of the parent? And then look at a combination of investment and protection.
Okay, absolutely. Now, that sounds very simple, but as I said, it's, I think, easier said than done. Mr. Rungta, I think let's take up the first point first. Knowing what is this corpus that you're trying to build, that itself can be a daunting task, because it might just seem like a 2,000, 3,000 rupee SIP today, but is it really going to be enough?
So you're absolutely right. How much should I invest, every month, so that whatever dream that I have for my child will be fulfilled? And I think for doing that, you really need, you have calculators and things like that, but the way you could do that is you decide that if your child was to get educated today, and I'm assuming primarily we are talking of education, that if my child was to be educated today, and you have no clue, right? The child is 2 years, 3 years, 5 years old. Nobody has a clue what is he going to do, right? But let's assume he would go for a professional course. What would it cost? And I think depending on your means, you could estimate that cost in whether that would happen in India, which would be slightly different, versus say if it happens overseas. And overseas is an euphemism for US, basically, at least in India. So you do that, take a certain inflation into account, and you arrive at the number that you intend to, that you need to invest.
So let's try and put this number out there, as arbitrary as it might be. But if you're talking about starting a plan today to create a corpus, let's say, 18, 19 or maybe 20 years down the line for a child that's just born today, for India, what would that lump sum be that you'd work with? And for the US, what's that lump sum that you'd work with?
So again, I think if you look at, and India is no longer as cheap as it used to be, but if you looking at undergraduation in India, okay, a professional course, assuming merit, again there are so many things, right? Assuming that he would get through in competitive exams, he or she would get through. Say maybe 10 to 15 lakhs a year in today's money, into 4 or 5. Okay, so that would roughly be 40 lakhs to 60 lakhs
And that's
in
just
today's
for education
money.
in India.
That's
Yeah,
right.
yeah.
And hold that thought about the just. The US, on the other hand, okay, you have to assume no scholarships, nothing. I would say about 40 to 45 lakhs a year, including living expenses, multiplied by the number of years. The other important thing, people tend to think that if I plan for my child's education, that's enough. That's not enough. Because guess what? When the time comes for the child's education, if you have not planned for your retirement, if you have not planned for other things, right, those needs are going to come in between. And there, you cannot plan in isolation for your child.
Absolutely.
You have to have a comprehensive plan. And I think a lot of people forget that.
That is the whole thing, because there are so many different things that are vying for that same pie of domestic savings. It's retirement, it's immediate needs, and of course it's long-term goals like planning your child's future. Let's also bring in Sweta Agarwal into the conversation. Sweta, now here's where it gets interesting. The marketplace is littered with products, and you have these fancy ads which urge the parent to save more and invest more. Your thoughts on the subject?
Right. So every insurer is now coming out with a child plan, because child future is dear to a parent's heart, right? Every child is like the most important being in the parent's life. So it is important that they do whatever best they can, not even only for education. They want to plan for the marriage, they want to plan for their comfortable living, they want to plan also for, suppose they want to set up a business. So all these, keeping in mind all these, the insurance companies have come up with plans which acts as investment cum insurance plans. So they not only insure the child's future, they also finance the major turning points in their life, as we just discussed. So this is where insurance differs. It is not only into investment, it also insures the child's future by covering the life of the parents. So what, suppose you are investing in mutual fund or equities, but what after 2 years suddenly one of the parent dies? So who is to pay the continuing investment? This is where insurance comes. They have a rider called waiver of premium. So in case something happens to the parent, the premium payment still continues by the insurer itself. So the burden of continuing the investment does not fall on the child or the family.
Okay, fair enough. At this point, this conversation is going to get really, really interesting. And I must tell our audience that we have diverse viewpoints and opinions on the show today. And that's because it's to each his own. It depends on your goals, your planning and your risk appetite. It's not a one-size-fits-all kind of a situation. So let's just take it one step at a time and look at products. Starting first with what the mutual funds are offering. We'll keep insurance away for a bit right now. Now, interestingly, as I was trying to do some homework, I realized that even asset management companies are offering so-called child products. Now, I don't know how this works. Mr. Bhave, if you could explain, are these just plain vanilla mutual funds which are just called child funds? Are there any additional benefits or features?
So these are mutual funds plus something. So for example, there is HDFC Children's Gift Fund Plan, and there's ICICI Prudential Child Care Fund. Now both these are hybrid funds. So they have a component of debt and equity. The difference is that there's a 5-year lock-in. The difference is that the money can be taken out either at the end of 5 years or when the child becomes 18, whichever comes later.
Okay.
And the difference is there's a small insurance cover which is actually just an accident cover. So
okay, this cover covers who? The parent?
The parent.
The parent.
But I wouldn't recommend buying this as a child plan. You can buy a normal hybrid fund which will serve the same purpose. But in my view, if you have a long-term goal, it is better to buy a pure equity fund, and later as the goal comes nearby, you convert to debt.
On the mutual funds which have the child tag to them, Mr. Rumta, so what's your thought?
See, I think this child tag, whether attached to a mutual fund or whether attached to an insurance company, these are marketing jargon. Okay. And I think the mutual funds have come up with this as a half-hearted sort of riposte to the plethora of child plans that are available from the insurance industry.
Side,
my advice, strong advice to every parent, okay, If a plan advertises itself as a child plan, it's not a right plan. Just keep away. I'm absolutely clear.
Well, I told you, viewers, that this one is a hot debate on money, money, money. So we have to take a very quick break. But we'll get into the nitty-gritties why Mr. Rungta says that don't go into products that have the child plan tag with them. And then there is a counter view which suggests that yes, there is discipline which helps you save and invest properly through these products. The debate will continue on the other side. Don't go anywhere. Welcome back. You're watching Money, 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 and this is the Children's Day special. We are helping all you parents out there answer that fundamental question: how best can you secure your child's future? There's a big debate going on the show this week, and that is whether child plans really merit your attention or not. So before the break, you were making the point that these products probably are not worth your while. Now, why would you say that? Because the counter view that I'm getting from the other guests is that at least child plans inculcate a level of discipline. It's goal-oriented. That money cannot be touched or utilized for any other purpose. So what would you say to that?
So obviously, like any other argument, there is a point on both sides. But I think if you're using discipline to support, at least on the insurance side, the mutual funds are not so bad. Okay. The insurance side, clearly, you're talking of some 3%, 4% returns. Come on. Because you don't trust yourself, because you're not disciplined, you want to lock in your money at 4% for 20 years. I leave that decision to...
I agree. That's a strong argument, and one must keep it in mind while coming to the choice of products. But that also brings us to really what the insurance industry offers. Now, Sweta, let me bring this back to you. Just break it down, simplify it for us. When we're talking about child plans offered by insurance companies, are these ULIPs or are these traditional plans? What are the rates of return? Just kind of simplify these products for us.
Yes. So child plans do come in options. You can have ULIP, which is linked to equity or debt market, and then there are traditional plans like endowment plans, which depends on the time invested there. So depending on your needs, if you are a little risk averse, you should go for endowment plans. But if you are ready to take risk, then you can go for ULIPs. It depends on from person to person. It's unique needs of the person. But as Mr. Harsh said, the returns are very low. Yes, they are low. They range from somewhere around 3 to 4%. But when we look at the advantages in the long term, they outweigh the higher costs, the higher premiums that we are paying. The biggest worry of a parent is the rising cost of education, followed by the lack of discipline, not saving enough, not having enough knowledge about the plans available in the market. So how do you counter these? And also, according to the National Crime Bureau statistics, an Indian dies in an accident approximately every 90 seconds. So how do you cope up with these? So this is where insurance comes, be it a ULIP plan, be it a money back plan, be it a traditional endowment plan. These will cover your risk of uncertainty of future, right? Death is the only certain thing, and time of death is the most uncertain thing in life, and insurance covers both of these. So if you have planned for your child, you should take...
Shweta, I take your point on that, but let me just ask you a quick counter. Since you've been studying these products for a long time now, as you mentioned, if it's a traditional plan, endowment plan, then it's going to, the return is going to be a mere 3-4%. ULIPs, in your experience over long periods of time, child plans which are market linked, what kind of returns are they generating?
Yes, so they may generate over 6 to 7%, but again it depends on the market. So right now, if we are talking about, the market is down, so you will not get that much of returns. But otherwise, ULIP plans still give you more than 6% on an average.
Okay. Mr. Bhave, I'm taking this back to you now. Another thought that did kind of strike me as, a positive factor of taking a child plan is this waiver of premium. Yes. And that's a solid argument. And I want to get Mr. Rungta in on this as well. Because, yes, till the time the parent is systematically investing in a mutual fund, that's fine. But God forbid if there is an eventuality, there goes that investment stream. Whereas if you have a child plan, then typically, even in the event of the parent's death, the future premiums get paid off.
Absolutely.
Does the policy continue as is in its form? What happens to the benefits, the payouts at the age of 20 or 25?
Completely as is.
Okay.
So I'll give you an example. For example, I have a son who is 10 years old and my wife is ex-banker. I will buy mutual funds and term plan because I know if something happens to me, my wife will know where to invest the money. But I had a cousin whose husband passed away, unfortunately, and when she got the term plan money, her uncle came and started discussing, should I put the money in property, should I put the money in gold? So if I am father and I am trying to create a plan for my son or my daughter, I would want to have complete peace of mind and lock my financial goals. That's the major advantage of a child plan. And unit linked plans would typically give returns of 8% plus, as Sweta was saying, as the markets do well. And for a particular profile where you are not sure what will happen to the term plan money in case of a death, a child plan makes perfect sense.
Mr. Runga, does this cut any sort of ice with you, the fact that at least future premiums are waived off, so that death uncertainty gets taken care of?
See, I think one thing is very clear. Nobody can argue against insurance. So just doing investment is not enough.
Sure.
That's like that's like Sachin Tendulkar going out to bat without pads. And insurance is an absolute must. I've never argued against insurance.
Sure.
All that I'm saying is don't mix it up.
Okay.
Coming to the waiver, okay. Again, what is waiver? What waiver does is that it pays the premium for you into that policy, so that it matures at the normal time. Okay. If you've taken a regular insurance, and now incidentally there are mutual fund products that offer life insurance for free, genuinely for free. Okay. But coming back, instead of a waiver, if the money comes, okay, whatever is the amount that you had envisaged, if you have taken a term cover, that money would come. Suppose you need it after 10 years and unfortunately you die after 2 years, the money comes after 2 years. Right? Sure, there is an argument that money might be squandered, but that's where what I mentioned.
Knowledge.
That you cannot, one is knowledge, you can never plan in isolation. Okay? So, I mean, what is the use of being assured of your child's future, but other things if they are not been planned properly?
Sure.
Okay.
Sure.
So that is why if you have planned in comprehensively, if you have
in
planned,
a holistic manner,
I don't think this is a problem at all. That is at least my view.
Okay, fair enough. But for the benefit of viewers who are interested in insurance offerings, child plans which are offered by insurance companies, let's just get in some examples as well. Mr. Bhave, then the sort of products that you would perhaps keep in mind or recommend. I don't know, when these traditional plans, the endowment policies that even Sweta mentioned, 3-4%. I don't know if that really makes sense. Or otherwise, ULIPs, if you could just name any products that you like.
So we wouldn't recommend anything to an investor which is not linked to the risk profile. Even today there are certain investors who want zero risk, and that's the only place where we'll go with the endowment plan. But if you look at a unit linked plan with a waiver of premium, there are two good plans. There is ICICI Prudential Smart Child Plan, and there is Aegon I Maximize Option 2. Where they have a clear waiver of premium. That's what we would recommend.
And typically, what are the kind of sum assured that these plans offer?
So that is 10 times, 10 times of the premium that you pay, but you can take a higher cover also.
Okay.
So it's completely left to the individual.
Okay. Sweta, same question to you. Some thoughts, products that you are recommending to your clients?
Right. So if we go by LIC, people somehow prefer LIC even today. So if we go by LIC, Jeevan Tarun is a good policy. It's a money back policy, so you can take the policy as soon as the child is 90 days old, and there's no limit to the sum insured as high as you want. This starts paying once the child achieves 20 years of age, and up to 25 you get some percentage of the sum insured, and at maturity you get the entire amount. If you take waiver of premium as the rider, you also get death benefit at the death of the parent. If you go to private insurer, there are policies like ICICI Pru, Smart Kid Premier or Young Assure plan. So Smart Kid Premier is a ULIP plan wherein you have a choice of investment in the funds available, and you get equity linked returns. Then there's Bajaj Allianz Assure plan, wherein again the parents' death is covered in case something happens, and the returns are as per the endowment plan, the traditional plan. So these three are good plans and recommended from our side.
All right, Sweta, thanks very much for some of those thoughts. Of course, those are some ideas that our viewers can perhaps look at, do your own homework, your own research. As we said, this is not a one-size-fits-all approach. It depends on your aspiration levels, your income levels, and of course, your own risk profile. We need to take a very quick break. On the other side, the DIY, the do-it-yourself approach when it comes to securing your child's future. If you want to go on your own and do the right mix of insurance and investment for your child, we will help you out by getting you the right balance. Back in just a moment. Welcome back. You're watching Money, 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 and this is the children's special. It is, of course, Children's Day throughout this week for us right here on Money, Money, Money. Now, we've discussed, of course, the merits and the demerits of going in for child plans. They come in different shapes and forms. They could be market-linked or they could be traditional products. But now, if you don't want to opt for something called the child plan, then how do you construct the right mix, the right balance between insurance and mutual funds, the investment part of it? So that's an approach, sir, that you've been advocating. Where does one begin? I mean, is it good enough to just have a comprehensive 1 CR term plan and the rest can be just mutual funds? I mean, how do you segregate these things out to ensure that your basic goals are met?
So I think segregate is the right word that you have used. Take your term plan separately, not just safeguarding for your child's education, safeguarding for, as Abhijit mentioned, your retirement, all your other needs, so that if you are not there, even then those needs will be met. I think that's separate. It should be de-linked from your investment. Now when you look at investments, and now you're looking at, let's say, for your child's plan, now most people, okay, tend to have a dream that they would send their child overseas, right? And I think that's where so they have a dollar exposure. You should look at investing in mutual funds. At least a portion of what you goes for your child, so that you get some element of cover against a rapid depreciation of the rupee. Okay, so you invest in mutual funds that in turn invest in
foreign markets. So you're talking about some of these US equity funds, US blue chip funds, etc. Right. You even have, you know, Greater China, emerging market, Asian equity funds.
So I think, as I mentioned right at the beginning of the show, in India, foreign education essentially means US or at most UK education. So effectively, you should look at dollar exposure, if that is your phrase.
I want to add something here, you know. He used the word HNIs, and I know HNIs do watch your show. And there is a liberalized remittance scheme of Reserve Bank of India, which allows investment of $250,000 per financial year per person. And as he rightly said, we have a lot of people aspiring to send their children to the US for education. And there are US funds, fund of funds without insurance, which will invest in dollars for you. And in the last 40 years, if you look at rupee and dollar has appreciated by 4% per annum for the last 40 years on an average. So if you have a vehicle there where it will invest in local funds, there are funds by JP Morgan or by HSBC or by Fidelity. And certain platforms actually have an option of, without remitting the money back, sending it as a fee for education. So that is typically a HNI kind of a product. But that is something I would also request your viewers to take a look at when they look at the segregation for funds for foreign education. For foreign education.
And finally, coming down to, you know, last thoughts and the most important thing of it all, really insurance. What if I'm not there? And since this is a Children's Day special, we're talking about children. If you're not doing a child plan, and if you're going to, you know, construct your own insurance matrix along with your financial planner, then Mr. Rungta, term plan, 1 CR, 2 CR, 3 CR, or any other type of insurance policies, what would you recommend? What would go in?
So instead of putting a figure, I think it should be a multiple of your income, right? So typically, if you are between 30-40, it has to be a 15 to 20 multiple. Okay, as you grow older, the multiple will keep coming down. Although the income will go up, the multiple will keep coming down. So I mean, after your 40-45, maybe 8 to 10 times. But till 45, I would say at least 15 times. If you're 35, it should be at least 20 times.
Okay, fair enough. Mr. Bhave, any last thoughts, any tips, any advice you'd like to leave our viewers with?
I think it's a combination of investments and insurance, and I think it is something that deserves 100% attention, and I would request every parent who loves their child to look at financial planning for child education as their top priority if they have not done it till now.
I think it's wise words and a lot of food for thought to end this episode on. Thank you very much for joining us on the show and shedding light on a lot of these important aspects. We hope this conversation has been fruitful and useful for you viewers out there. So along with planning your vacations and along with planning all the shopping, make sure you're planning the future for your child as well. We'll take your leave on that note. Thank you for watching. Your feedback, comments, queries, welcome as always. We'll see you again next week.